How does a Bitcoin exchange, traded fund, ETF, operate? In this video we will talk about Crypto ETF. But before we start, make sure you have subscribed to our channel. Let's get into it. A cryptocurrency exchange, traded fund, ETF, is a collection of several cryptocurrencies that monitors the price of one or more digital tokens. How does a Bitcoin exchange, traded fund, ETF, operate? Due to their intraday liquidity and affordable transaction costs, exchange traded funds, ETFs, have gained appeal as a form of investing since the middle of the 1990s. ETFs typically track a certain index and are traded on exchanges. Unlike mutual funds, which only let investors to buy or redeem shares at the end of the trading day, ETFs allow investors to trade their shares continuously throughout the trading day. A cryptocurrency ETF is a fund that invests in several cryptocurrencies and monitors the price of one or more digital tokens in the cryptocurrency market. This post will go over the advantages and risks of cryptocurrency ETFs as well as how an ETF operates. What is an ETF for cryptocurrencies? If a fund satisfies either of the following two requirements, it is regarded as an exchange traded fund. Blockchain technology is being developed and used by corporations to alter commercial applications, according to cryptocurrency ETFs. Blockchain-based ETFs make investments in futures and options, whose prices are dependent on the performance of Ether and other cryptocurrencies, or in cryptocurrency investment products offered by asset managers like Bitwise or Grayscale. In general, blockchain technology's extended use case is represented by cryptocurrency ETFs. The first cryptocurrency ETF to attempt to track the price of BTC, the most valuable cryptocurrency among digital assets, is Bitcoin. ProShares Bitcoin Strategy ETF, BITO, Valkyrie, BTF, and VanEck began trading Bitcoin ETFs on October 18, 2021. XBTF. The managers of these products keep an eye on the price of BTC via the futures markets. Despite the fact that there are no ETFs that are tied directly to the spot price of Bitcoin, the current market price at which the underlying security may be purchased or sold. Additionally, because Grayscale's Bitcoin Investment Trust is not an ETF, it is not accessible to the general public. Bitcoin ETFs could be risky for investors if the fund holds a sizable share of the futures market in addition to providing indirect exposure to BTC. Investors should use caution when purchasing speculative securities like cryptocurrencies. How does an ETF for cryptocurrencies operate? While traditional ETFs directly own the underlying asset, cryptocurrency ETFs either own cryptocurrency futures, options, or other crypto-based products. The goal is to mimic the price variations of the underlying coin. Because they don't hold any of the underlying cryptocurrency directly, there may be times when the ETF fluctuations don't exactly track those of the underlying cryptocurrency. ETFs that invest in cryptocurrencies are either backed by real, world crypto assets or artificial alternatives like derivatives. In the former, cryptocurrency investors indirectly possess cryptocurrencies without incurring any costs associated with outright ownership, and in the latter, the ETF share price imitates the price movements of derivatives rather than reflecting the values of actual cryptocurrencies. Therefore, why are crypto ETFs significant? The most obvious rationale is portfolio diversification. Since investors in Bitcoin or Ether ETFs can gain exposure to multiple crypto assets, especially outside of traditional securities markets. What advantages do cryptocurrency ETFs offer? Despite regulatory ambiguity surrounding Bitcoin ETFs, holders of exchange traded funds may gain from the following. The affordability of investing in a risky asset class is the main advantage of exchange traded funds like ProShares Bitcoin Strategy ETF. When investing in Bitcoin ETFs, the learning curve is delegated to analysts, making it the perfect investment vehicle for newcomers. Investors can avoid expenses like network and transaction fees, custody fees, and other costs by owning cryptocurrency ETFs. Investors can feel secure in knowing that an ETF provider is in charge of the security of the fund, especially in the event of phishing, cryptojacking, or crypto heists. The infrastructure needed to acquire and trade cryptocurrencies is not yet fully created. For example, although some tokens are available on particular cryptocurrency exchanges, Others are not. However, cryptocurrency ETFs allow investors to diversify their portfolios without having to pay for individual tokens. The safety of cryptocurrency ETFs. Before determining if Bitcoin exchange traded funds are secure, let's first address the questions of whether they are regulated and whether they are suitable for novices. To prevent market misuse or the funding of criminal operations, all parties engaging in cryptocurrency ETF investments are subject to authentication and have their trades monitored. Having said that, because cryptocurrency exchange traded funds are issued by regulated businesses and traded on well-known regulated platforms, investors can do so with greater confidence. Despite this, there hasn't yet been a Bitcoin spot ETF, despite the U.S. Securities and Exchange Commission receiving numerous requests to approve crypto spot ETFs. A few companies have, nevertheless, given their approval for the Bitcoin futures ETF. In addition to regulation, one should be aware of the hazards associated with investing in Bitcoin exchange traded funds. For instance, while starting to investigate Bitcoin ETFs, novice or experienced traders must be aware of the limited selection of funds available. Additionally, the funds are vulnerable to cybercrime risks like hacking and only follow a small number of digital currencies. Furthermore, given the volatility of the cryptocurrency market, it is certain that investments in cryptocurrency exchange traded funds may also see significant price swings, particularly in the case of funds with physical backing. As a result, investors are ultimately responsible for the safety of any cryptocurrency investments, and this depends on their understanding of the advantages and disadvantages of various financial instruments. How do I purchase a cryptocurrency ETF? If you don't want to actively manage your cryptocurrency investments but still want to diversify your portfolio, a cryptocurrency ETF can be a better option than purchasing digital assets directly. The steps listed below can be used to invest in blockchain-based ETFs. By completing their onboarding procedure, open an account with brokers like Fidelity Investing, Robinhood, etc. Choose the portion of your overall investing budget that you want to dedicate to ETFs. Invest in your brokerage account, then search for the ETFs you wish to buy. For instance, enter BITO, ticker symbol, into the search bar if you plan to invest in ProShares Bitcoin Strategy ETF. If you wish to purchase any cryptocurrency ETFs, place a market order. Select Buy. Enter the most shares you can buy within your current spending limit. Set up an automated investment plan with your broker if you want to grow your investing account over time. Although the aforementioned procedure is straightforward, you should be aware of the expense ratio or management fee related to ETF investments. For instance, holders of exchange traded funds and mutual funds are liable to an annual charge known as an expense ratio. If you're curious in how ETFs are funded, read on. The expense ratio is the answer in that case. ETF providers generally make money by charging transaction fees and expense ratios to the funds. One should consider their departure strategy as well. For instance, even hodlers, or long-term investors, may want or need to sell some of their holdings at some point, necessitating the payment of additional trading fees. So this is it for today's video. Make sure to subscribe to our channel for more videos. Thanks for watching.